So good morning. Thank you everyone for coming. I'd like to introduce, I'm Matt Comstock from Murphy McGonigle. I'd like to introduce the panel. On my immediate left is Richard Gorelick, who is head of market structure at DRW Cumberland. To his left is Chris Housser from Polymath. He is co-founder and COO Polymath. To his left is Alan Konevsky, who is the chief legal officer at tZERO. And to his left is Colleen Sullivan, who is partner and CEO at CMT Digital. So thanks, everyone. So the panelists and many of you in the audience this morning heard the regulatory panel and some of their discussions around this space. In particular, there was a discussion from Valerie Stepanek around, among other things, ICOs. So as many of you know, ICOs were sort of frothy in 2017 going into 2018. The SEC took a number of actions, and that has the ICO industry, or the ICO markets in the United States, have more or less ground to a halt. So there's now sort of an inflection point, and we're moving more into STOs, security token offerings. So this involves actually issuing a security in compliance with federal securities laws in tokenized form. I think that begs the question, why? So there are robust securities markets now. What's the business case for issuing securities in tokenized form? Alan, you want to kick us off?
Sure. And look, I think it's a great point to recognize that we're not talking about an evolution or a development from the ICO space to the STO space. We're really trying to build a new ecosystem and a new approach to capital raising and trading of instruments representing that capital that is driven by innovation, both on the technology side, on the financial instrument side, and on the regulatory side, but a journey that is iterative and incremental and is firmly focused on evolving in a way that is fully compliant with regulation and is in partnership with the expectations of the regulators. Now, if you look at the benefits that that security tokens bring, you can really break it up into two pieces. There's kind of the front-end benefits and the back-end benefits. And on the balance, probably more time is spent talking about the back-end benefits. We've heard a lot about reduced costs, greater transparency, lesser potential for asymmetries of information, for manipulative activities, and obviously, that's to a large extent a function of the journey that is going to be driven by keen focus on regulatory developments. The front-end benefits, you really look at the flexibility that security tokens, or rather securities that are represented by a token, can bring from an issuer's perspective and from an investor's perspective, where you aren't necessarily beholden to the traditional models of equity, debt, securitized assets, but you can design instruments that are, from an economic perspective, from a governance perspective, a lot more flexible and bespoke, and really get to the needs of the issuer and the investor pool, whether in terms of the revenue or profit distributions that they offer, whether in terms of the governance, whether in terms of the flexibility and the mutability, and we'll get to that later in the session, that the instrument brings. Once something is designed, it doesn't need to always be the way it was at conception. The rights and privileges that an investor has from an economic or from a governance or other perspectives can change over time depending on a number of factors, including the behavior of the investor. Of course, subject to designing these instruments in a way that complies with corporate law and applicable securities laws.
Okay. Great. So that brings us, I think, at least for a little while, to some of the regulatory questions, right? So we're talking about moving from ICOs to security token offerings. And again, issuing the securities in compliance with the federal securities laws. But there may be some regulatory uncertainty around that process. So Richard, do you want to discuss some of those issues?
Sure. So thank you, Matt. So DRW, Cumberland, we have a lot of different interests in the, let's call it the crypto space. One of our primary businesses is our Cumberland trading desk, which trades in the secondary market, one of the largest traders in the over-the-counter market for digital assets. And we specialize in large institutional size liquidity. So our approach to this market comes from the trading side. And we've got over 25 years of experience trading in more traditional regulated asset classes around the world. We're sort of bringing that perspective and looking at the digital asset space and seeing how do we think things should evolve. What we saw in 2017 primarily and into the early days of 2018 was this big ICO boom and then subsequently the bust. And what we saw around that was, in addition to questions about the qualities of some of the offerings that came out, was a lot of changes in people's views on the regulatory state of these ICOs. I think there was a lot of misplaced enthusiasm for the fact that these might be outside of traditional regulatory frameworks early on in that process. And gradually, the SEC sort of caught up with guidance saying, well, wait a second, we've looked at this stuff, and most of this looks like securities to us. We're now left with sort of a question of figuring out what does most of the, what does most mean? What are the boundaries between the ones that really are securities and the ones that might not be securities? We learned from Chairman Clayton last year, taking a very pragmatic approach, that, if something acts like a laundry token in a mature laundromat, that doesn't sound like a SEC function. That's more of a consumer function. We heard from Director Hinman subsequently later in the summer that Ethereum in particular, while it may or may not have been a security at the time it was issued, by the time he was looking at it last summer, it didn't look very much like a security to him. It had become sufficiently decentralized. So now we have some guidance from the SEC, the beginnings of guidance, that there are some things that are not securities, that are digital assets, but the exact boundaries of that are still to be determined. And so we think it would be quite helpful to keep going down that road, to get the guidance from the SEC. I'm very, I would say, empathetic of the problem that the SEC is trying to solve here. They've got a round peg of very old, decades-old securities law that they're now trying to fit these round peg, square hole, yes. I guess the securities regulation of is the square hole. The round peg is all these ICOs that are coming out. With all this uncertainty, we've seen the ICO market, as you mentioned, really ground to a halt. And in sort of a lot of the energy in recent months has been in the STO market. And I agree with all of the promises of this that Alex mentioned. But generally, what we're talking about here is securities. There are equity securities. We understand how they're to be regulated. We're using the technology in order to make the process of issuing and trading these instruments much more efficient and flexible, transparent, and something that we're see a lot of promise in.
And I'll add to that. Yeah, so right now what we're talking about is these security tokens, or tokenized securities, as people like to call them now. But there's transfer restrictions built into trading of equities, trading of bonds, that don't exist in the ICO market. In the ICO market with ERC20 tokens, they're freely tradable to any addresses. But if you want to create a tokenized security, you have to put restrictions in place so those tokens can only be traded to authorized investors within the criteria that meet the regulations that allow those trades to take place. And that at Polymath is what we've built. It's a system to restrict the trading of tokenized securities to only authorized individuals. And I think the more projects, the more exchanges that build out similar features and that can work together to really restrict the trading of these tokenized securities to only authorized individuals is what this space needs to really grow forward and help the regulators understand what's happening in this ecosystem.
Yeah, I think that's absolutely right. I think if you're looking at at security tokens as a security for federal securities laws purposes, and what needs to happen at the point of issuance and offering, as well as at the point of secondary trading, in order for the issuance and for the secondary transfers to be compliant with federal securities laws, you are really looking at two paths at the point of issuance of the securities underlying the token, and either it's done on a fully registered basis or it's done pursuant to an exemption from registration. And if it's done pursuant to an exemption from registration, there can be parameters in terms of the appropriate universe of investors who are permitted to receive these tokens. Likewise, if you're looking at the enablement of secondary trading in these securities, it's, unless the tokens were issued in a fully registered offering and listed on a national securities exchange, and tZERO has been working in partnership with the Boston Options Exchange to design and build the first U.S. national securities exchange focused on digital assets, subject to regulatory approval. So that's one path, and the other path is for transfers to occur in transactions pursuant to an exemption from the requirements of federal securities laws, including transfers among certain types of investors, like accredited investors. So, and in that case, the technology itself can help to police the requirements that you need to comply with under applicable law.
Can I pick up on that for
Yeah,
a second? Because there's a couple of concepts you mentioned there. We're talking about transferability, and then you did mention the options exchange, which brings something to mind. But I think it might be helpful first to kind of contrast. So you've got Bitcoin, which is, for the most part, fungible, right? So I can open a position on Kraken, and I can transfer my coin to Coinbase, and I can sell the same coin there. So Bitcoin is, you can transfer it across all these different exchanges, fully fungible. It's important to note that in the United States and in most jurisdictions worldwide, it is illegal to issue securities as bearer instruments. So Bitcoin is a bearer instrument. Whoever owns the private keys owns the Bitcoin. With a security token, if I lose my private keys, I can go to the issuer and say, hey, someone stole my private key. Can you issue me a new one? And they have to. It's not a bearer instrument. So there's a distinction there that I think is important and introduces some friction into the ease of transferability just generally before you even get into like selling under an exemption with securities laws. And a lot of what we're talking about is tokenizing private securities. And so I think there's a few things to think about there, just in terms of, I think the goal we all want to get to is that we have these tokenized securities that can trade globally across all these exchanges in a frictionless kind of manner, 24/7, open up all of this, illiquidity, turn it liquid. But there's a couple things. Let's say that I own a fraction of this building as a security token, and you own a fraction of this building as a security token. My token is, let's just say it's been issued on NASDAQ. Yours has been issued on the New York Stock Exchange. NASDAQ used a different blockchain, different technology to build my security token than what New York Stock Exchange did for you. So we can't transfer those security tokens across exchanges until we have uniform standards across all these different platforms that are popping up. And it could turn out that, similar to our options markets, the regulator, the SEC, basically said that the Options Clearing Corporation had to have all of the listed options exchanges clear in this one place, so all of the listed options were fungible across all these exchanges. That created increased volumes, decreased prices. The exchanges then had to compete in different ways. And I think that's where we'll eventually see this marketplace go.
Okay.
If I can pick up on all of those thoughts, I think it was really interesting that we're talking about transfer restrictions, that we're talking about issues in fungibility, and that we're talking about sort of limited universe of purchasers who can buy these things. These are all traits that are required by the federal securities law and that are very understandable in the context of the federal securities law. But we get to this round peg square hole problem when we've got consumer-oriented tokens or utility tokens where it doesn't really make sense to apply the securities law. The issues at stake aren't the same. If I want to sell access to a public, distributed, decentralized computer network for storage or something like that, if I can only sell it to accredited investors, that doesn't really work. If I need to be an accredited investor to use a token on a consumer network, this is an area where there's presently a lot of uncertainty about what the rules are. We're waiting on the guidance that I mentioned earlier to help enable some of these projects to really get off the ground.
Yeah, and Richard raises a great point because I think we've all kind of figured out, for the most part, what we need to do for the initial issuance of security tokens, but it's the post-trade kind of back-end clearance, settlement, how do I use them, where, and especially where we're kind of blending our public markets with our private markets, there's no legal architecture set up for like a robust private security token market. So that all, I think, needs to come.
Yeah, there's been a number of projects that have issued security tokens, blockchain capital being one. 2 years ago, they did it compliantly at the start on primary issuance, but then they were ERC20 tokens that were freely tradable to anyone, and that was problematic. So they had to call those tokens back, and now they've been reissued under a more limiting structure such that they can only be transferred to authorized participants. And we'll see more of that being developed in the coming years.
Yeah, and for the tokens that tZERO issued last year, earlier this year in January, we launched secondary trading of those tokens on an alternative trading system. The trading is available among accredited investors only in reliance on an exemption from federal securities laws, and that's a path for creating a piece of the overall STO ecosystem that would enable issuers that are private and wish to remain private to provide secondary liquidity to investors in their securities.
And here's where I think we may need more clarity for that secondary trading. So if you are an ATS, you know, again, kind of that blending of public and private rules and regulations, you know, does the ATS need to register as a clearing corporation? Does the ATS, you know, do you need a transfer agent in the mix? Does the issuer need to use a transfer agent? Customer protection rule with custody, like we need to modernize our custody rules, right? So you can have control, hopefully, on a blockchain at some point. But there's a lot of this back-end stuff that needs to be figured out.
Well, yeah, and I think with respect to public issuances of securities, so non-restricted securities in a Reg A offering or a fully registered offering, you know, obviously those require going to the issuer has to go to the SEC, has to file a registration statement for certain offerings or file an offering circular for a Reg A offering. You know, the SEC hasn't really said, to the best of my knowledge, sort of what are the criteria around approval. They haven't said you can't do it, but it would be helpful to have, I think, that type of guidance.
Yeah.
So we've sort of touched on this a bit, but let's talk about mutability. Just someone want to discuss what mutability is and sort of what some of the concerns or issues are?
So the one beautiful thing about the blockchain is that there's this perfect ledger of all historical transactions that have taken place, and it's immutable. It can't be changed. And I think that's one wonderful thing about these security tokens, especially for private placements. Now there can be no more backdating of documents. You can't move shares around. It creates a system whereby at any point in time, the regulators can look and they can see what shares anyone held at any particular time. The problem with this mutability situation is that, as we've seen both in Bitcoin a few years back and Ethereum many times, there's been forks. Especially, let's talk about the Ethereum Classic fork, and then there was 2 chains that went off. Imagine if there was a security token before that fork, and now there's a security token on chain A and chain B. What rights do the security token holders have on each chain? And I think it's really important that the offering documents specify what will happen in the case of a fork, how will our security be represented in the blockchain system in those sorts of situations. And these sorts of situations need to be accounted for and thought of ahead of time so they don't run into a situation where a fork happens and there's been no disclosures about what could happen in that situation.
But immutability is a great premise for a lot of these technologies from a ledger standpoint to add trust and verification to the whole process. But in the way that sort of day-to-day trading works in regular financial markets, it's also a problem. It's very common to have trade breaks, for example. And so if people make mistakes. And so if people are dealing with these things, people are highly mutable. And so for a variety of reasons, you want to make sure that in the technology and in the offering documents and in the trading platforms that there are ways to reverse things that are well understood and that are contemplated early on in the process.
Okay.
Yeah, and look, mutability also goes, it cuts across a number of vectors, a number of topics here that folks touched on. One of them is mutability of the security itself, and we talked about that briefly. Something that starts out as a common share that gives you one vote and entitlement to dividends if the board declares them will always be that type of a common share until a major corporate transaction happens, for example. Here you have an ability to design instruments that can mutate, change, evolve over time, again, depending on what happens with the issuer, depending on actions of the investor. For example, if you want to discourage or encourage certain behaviors on part of the investor from a holding period perspective or other behaviors, that can all be built into the DNA of the security. The economic rights can change, again, whether based on metrics relating to the issuer, based on actions or inactions relating to the investor, or other criteria. You could have something that is a security and does derive its value from entrepreneurial actions or revenues of others, but it could, and that's really an important thing here, is that and as you talk about the break from ICOs to STOs, is that you're looking at businesses, you're looking at operating assets, you're looking at projects that are businesses or operating assets in their own right. But alongside of an entitlement to economic governance, another entitlement to those businesses or assets, you could have a utility function. And that utility function can fall away over time, or as it's exhausted, or based on passage of time or other events. But the security function that's always been there from the beginning can continue, right? So or change over time as well. So these things can evolve.
Right, and it was mentioned earlier in this panel that the Ethereum sale in 2014 was arguably a security sale, and Ether itself may have been a security in 2014, 2015. But Bill Hinman said earlier in the summer that now it has morphed to such a state that it's so decentralized that the Ethereum token is not a security, but it's a utility coin. So yes, that type of mutability can happen as well.
But we don't know what that inflection point is, right? When did it change from a security to a non-security?
Right, and also there's a suggestion that something can be a non-security and go back to being a security if certain things happen. And I just think our regulatory environment is not used to this. This is something that we're going to really need to adapt to. Bright lines, clear guidance, different ways of understanding what we're dealing with will be very helpful.
Yeah, no, absolutely. I think the checks and balances picture that has evolved over time since the 1930s. Evolved in response to particular set of behaviors among, with issuers, investors, and other intermediaries, including regulated market participants. And as that changes, because you are now looking at different, instruments that can behave differently, in a way that, in a way that is disclosed, in a way that is compliant with regulation. How does the world change?
Let's talk, excuse me, a bit about custody. That's come up. That came up this morning on the regulatory panel. We briefly mentioned it. If there's going to be trading of tokenized securities, there are likely going to be, or at least at this point, necessarily going to be, need to be brokerage firms involved. And those brokerage firms are going to have customers who want to trade tokenized securities, and those brokerage firms need to custody their customers' securities. And in the broker-dealer world, there's a specific rule that applies to broker-dealers and tells them how they have to custody securities. That rule, consistent with the other discussions we're having on our panel, was not written at a time that ever considered tokenized securities. But it is flexible in the sense that it sort of lays out these ways that broker-dealers have to custody the securities, but also gives the SEC the ability to issue guidance that says you can also custody securities here. You can hold them in a certain way. To date, that guidance has not been issued, and it's consistent with what we've been saying. It's not an easy question. I mean, there are there are issues of cybersecurity. There are questions about whether or not there have to be transfer agents involved, along with the cybersecurity. I think the private key issues. I'd be interested in the panel's take on some of the custody issues.
Yeah, I mean, so you've got your broker-dealer custody issues, and then you have your registered investment advisor custody issues. On the broker-dealer one, I think it's just trying to figure out how can holding the private keys be deemed, good control and possession. So either the broker-dealer has to hold the keys, or a third party holds them on behalf of the broker-dealer. But is that even sufficient? We heard earlier that there's concerns perhaps about, well, how do you show those are really your private keys? Right. Do you need to bring an auditor in to look at that? So, I mean, we're hopeful that the SEC will provide some guidance there. Like Richard, we're involved in the trading space, and also both of us do venture investing in the space too. We have a registered investment advisor that oversees our venture investing, and that investing is broad enough to invest in operating companies, in equity, and in tokens. On the token side, because we're an RIA, we would need a qualified custodian to hold those tokens. If those tokens are not necessarily like an ER, well, first of all, there's the question, are there really any qualified custodians at all? And I'm not sure the answer to that is yes. Because there's questions about whether, well, there's a lot of questions about that. I'll just leave it at that. I don't want to get in a fight after the panel with anybody that's claiming that status. So there's that. But then I think an interesting question is, so assuming there are qualified custodians, let's say that they're primarily comfortable custodying Bitcoin and ERC20 tokens. And let's say we're going to go into a project with a bespoke blockchain. They're going to issue their own tokens, and there's no standard for that. So, okay, I'm a fiduciary. I have to have them with a qualified custodian. So, and as a trading firm, we self-custody everything that we trade because there's not a custodian period that can move assets in and out of the environment as quickly as we can. So we really are confident in our processes and our policies, our procedures. So as a fiduciary, what wins? The custody rule where I have to go find a qualified custodian that may not know how to custody this stuff, or what we're doing on the trading side and our confidence in our ability to self-custody and be able to protect our assets for as long as we've been invested in the space, which is quite a long time. So I kind of wonder about that too, like as the kind of legal framework is catching up with the technology and where the industry is, like what wins there? Fiduciary duty, or I have to go find a qualified custodian that may not be able to do it as well as we can.
There's also the argument if the securities themselves are held by a qualified custodian, but the tokens represent an interest in those securities, or they're just a representation of the securities, but not the security themselves, do those same custody rules need to apply? I'll also add that we're building features as well. Colleen mentioned the bearer shares are generally illegal in most jurisdictions. What happens if there's a court order, a forced transfer to send those securities to another party? At Polymath, we've built features to enable that issuer to effect transfers of these token representations of these tokens to other parties if need be.
Yeah, we've talked about the features that the technology can provide in its DNA to enable secondary transfers of the securities in a way that is compliant with federal securities laws, for example, although you can look outside of the United States as well for applicable regulations. And by the DNA of the instrument will not allow it to happen any other way. Likewise, I think in this, this conversation around custody and security and control is really, this almost kind of virtuous dialogue between regulation and technology, because technology here, as it's built up to the core of its DNA, and the folks who are active at that level of design want to create something that is of no value to a person other than the holder of the instrument. And I think regulation that we've talked about, including the topic, registered versus bearer instruments, and the roles that regulated market participants, including transfer agents, including broker dealers, and as well as the issuer play, in ensuring that these instruments are, in the unlikely event of a security breach, including a cyber event, these things are of no value to anyone else.
Well, there's the ability, right? If there is a cyber breach, to your point, those tokens that have been stolen are just no longer to your point, of value. The issuer reissues the stolen tokens to the rightful owners, correct?
Yeah, and the securities, again, the token is not the security.
Right.
There's an uncertificated security that's sitting underneath a token. The security never left its proper pocket.
I would like there to be a world one day where the token itself is the security, but we're nowhere near there yet.
It's an incremental and iterative journey of innovation.
Right, so picking up on that, I mean, what we're really in favor of is an environment in which the regulators enable choice and innovation. And I think what Colleen was getting to is that we're in some of these areas that are still being worked through, like custody, we may be in a situation where regulation might require people to do things that would not be the optimal solution. Maybe they're better off at doing self-custodying for an asset, and maybe the regulation prohibits them from doing that. What we would like to see is a continued partnership between the technologists and the regulators, such that we get to a point where there is more choice for end users in this market, and that will spur the kind of innovation that we're all in favor of.
Yeah, and our regulators definitely, this is a tricky area, because the way that we tend to think about it is you've got this open source technology that's open to the world's entire population. And so I think the only thing we know is that how it looks today is not how it's going to look tomorrow. So you don't want to put regulations in place looking at the way things are right now, knowing that they're going to be entirely different. So it's a really hard job. That's why I think like the collaboration with the industry itself, so like Polymath, tZERO, Cumberland, CMT, who are in this space day to day, building products, trading them, just working together in a hopefully very collaborative way, I think it's going to get us to the right place.
I like to say we're not competitors, we're all collaborators, and we need to work together to grow this ecosystem.
Yeah, and I think the collaboration, you've talked about technologists and regulators. I think in order for this ecosystem, the STO ecosystem, from a point of issuance to the point of a robust secondary trading environment and everything that underlies it, in order for it to be vibrant and live, you really need collaboration that not only includes technology folks and the regulatory community, but also includes other traditional participants in the financial system, so bankers, lawyers, accountants, right? And there's a lot of thought and forward-leaning innovation that needs to come from those stakeholders as well in order for this to get off the ground.
Well, I see we're out of time, so thank you, everybody. I appreciate your input.
Thank you.